Dan, we talked a little bit earlier about the concept of the tensions between countries. Having lived 23 years in the US and 23 years in Canada, and generally a very happy relationship between countries, it's been sad to see some of the challenges that I hope it will resolve and work together. And I think, Will, maybe that's the optimism in me, but I think there's a lot of really good reasons that North America should work together as an efficient ecosystem. Some of the fear out there from people is saying, boy, this just can't get put back. You can't put the genie back in the bottle once there's these threats. Is it your view to say, well, the administration, people's views could change. You have Trump administration now. If it doesn't work out as ideally as they want it to, and hopefully it will, the new administration, whoever it is after, can certainly have a different tone that can reset things. So it's not necessarily like this is a multi-decade change the way people think. Is that a fair assumption? And I'll add one other layer into there that I've thought about as I've listened to different people as a macroeconomics roundtable last week, and this was debated. China and the US have had tension. If you think back to every political election, it's always highlighted. Back when Obama talking about, well, who's got with Romney, who's got stocks invested in China and whatever it is. I remember in some of those debates, that's been a tension that is far from new. Maybe it's just much more highlighted today, perhaps. But what are your thoughts about that as far as your more medium-term views of how countries can, think more positively, perhaps, about each other, and this not necessarily be, an irreparable type of damage from what has been caused?
Right. I don't think we're yet at and I agree with you. I think the genie can be put in the bottle. Obviously, the rhetoric on Canada, the 51st Day rhetoric has actually changed Canadian politics. It's if anything, so far that rhetoric has made the Liberal Party great again in Canada. It's given them a new lease on life, and they're probably going to win the elections this month. And that is, again, it's the sort of rhetoric that can be counterproductive even to the Trump's administration's own goals. Now the trade tensions with Canada and with Mexico, which are US's closest neighbors, and ultimately the US needs allies, especially in this sort of geopolitical tension with China. I'll talk about it. I think the genie can be put in a battle. It can be even put definitely under the next administration, but certainly even under Trump. I mean, he will negotiate with the next Canadian Prime Minister, probably Mark Carney. He's no longer calling him the governor of Canada. He refers to him as the Prime Minister. That's an indication.
Good step.
And it's a step in the right direction, I think. So I think that these things can be negotiated. Obviously, there's been a lot of bad blood. You look at travel numbers from Canada or Europe and the United States, they're dropping, and that's not nothing. That's about 9-10% of the US economy, tourism.
Yep.
But it's something that can be fixed. The question is, will it? And I think the incentives are there that after this period of churn and tensions, you will see again a move towards moderation. And by the way, it mirrors how Trump operated in his first term. As I said, I tend to look at precedents. So again, if you remember the renegotiations around NAFTA, they have been not to the same level as now, but they were quite choppy and again tense. And there was this kind of underlying, I would say, fear that there's a permanent breakdown. I don't think that happens even with Europe. I think there's a higher risk with Europe, and I think the risk of the US-Europe trade war is something I think it will be reined in, but it's something to pay attention to over the next few months.
That's helpful. Thank you for double clicking on that. And one of the things as we progress through our conversations, it'll be good for people to keep in mind, and we certainly do at Star Mountain from an investment perspective, is thinking about there's a lot of uncertainty. Where are pockets of higher levels of certainty, such as essential service-oriented businesses in the U.S. that would be less impacted positively or negatively from trade with Asia, tariffs, trade with Europe, and so forth. That's one of the things that we try to think of with an investment lens as we're observing all the unfolding. But back to you, Dan. Thank you.
Right. So on China, that's tricky because China is a strategic rival. It's been under every administration. You can think about Obama's pivot to Asia, which was a strategic move, plus the TPP, which none of them happened, of course. But it was this idea of strategically checking China, which is what great powers do. China's doing something very similar. So increasingly, I think that is, and that's one of our top risks for the year that comes out of this trade. I think that is it's definitely part of the trade, or it's almost slightly different because it has this underlying geopolitical tension. The other thing is if the United States wants to oppose China and pivot to China, it needs allies. It needs Europe, it needs Japan, it needs the East, South, and East Asian allies, and of course it needs Canada and Mexico. And one of the part of this reciprocal trade negotiations now is in the background, there is a discussion of coordinating with the Europeans, with the Canadians, the Mexicans and the Europeans, by the way, offer this to coordinate on tariffs and export investment restrictions against Beijing. So that, of course, will increase tensions. The map here shows you sort of a more or less how the world aligns now, or well, last year, but it hasn't quite changed. Again, the US is stressing its own alliances right now. And the question is, at what point does it stop and pivots towards sort of this strategic rivalry, or does it sort of continue this kind of omni-trade war that it will make it less efficient, and you end up with those scenarios I described that are sort of, you look at policy and efficiency. Now, the other thing that happens in this world, of course, there's a talk, especially with the tariffs between China and the United States, that the globalization is completely breaking down. It is and it isn't. I think the one thing that has happened for a long time, and this will continue to happen, is not regionalization. It's not going to be China and East Asia and Southeast Asia versus US and America. It's more a breakdown between, and the chart here shows FDI, and it's a pretty good IMF chart from 2 years ago, but it shows that over time, what happens is friends trade with friends, not with neighbors. So if you're geopolitically close to someone, chances are you invest with them. And that actually is one of the things that happens with Europe and the United States. They're very deeply integrated when it comes to mutual foreign direct and portfolio investment. So I think that if you're looking at a cleavage in the world, it's not necessarily regional. It's much more along these sort of, I would say, the map of the left, right? I mean, countries trade with countries from their friends. And that's something to watch. I think, as I said, the US is stressing this now, and, whether that's going to bear fruit or not, or whether it's counterproductive is still to be determined. But I think we're trending towards a world that increasingly, and Trump has said as much, by the way, 2 days ago, that he's going to force countries and companies to choose between China and the United States. I don't think it's a hard choice. I don't think we're at the point where there's a massive, complete break between US and China. There's a potential for a deal, but this is the trend.
Makes sense.
Now, the other thing that happens out of the tense world, and again, I don't think, there's going to be a war between US and United States and China. Sorry, some issues turning the slides, is that we end up in a period of geopolitical tensions between great powers, trade conflicts. And if you look at wars between countries, not civil wars, they actually show something really interesting. They show that wars cluster. World War I was not one, but it was a series of overlapping wars and alliances. Same about World War II. And then you had these two periods in the 50s and the 70s when the number of interstate wars increased. Now we have Hamas, Israel. We have, of course, the war in Ukraine. The question is, are we entering, especially with this kind of geopolitical US-China tension, another period where the global system is changing and is generating challenges? It doesn't mean that the great powers themselves will fight each other, but again, the Cold War, you had proxy wars. So the Soviets and the Americans never fought each other, but their allies did, right? So the question is, are we moving in the same direction? That, of course, has implications for a number of investments and for why I think this sort of national security heavy or focused industries and plays will play well in the future, because this will continue.
Yeah, and even seeing that the shipbuilding coming back into US and things that we've through our direct investing portfolio and our secondaries, we've been grabbing a lot of data from the roughly 1,000 private businesses in our aggregate look through portfolio and trying to see what are we seeing, where are there trends, where are things picking up, where are things slowing down. And it's been interesting to observe some of the alignment between the US's natural desires and some of the changes going on that way. And it'll be interesting to think about the number of businesses, often some really large tech businesses that have a high reliance on different inputs from China. How will that impact it? So different multinational businesses, it might make a much bigger difference where you were working with. Was it Europeans versus Asians, and how that could impact the future is certainly an interesting question that we're observing in supply chain disruption and so forth.
That's absolutely right, I think. I think that, again, the US now has a focus from the White House that's top down on rebuilding shipbuilding specifically, right? Because it's a national security, plays into the size of the Navy, into merchant marine. Now that takes time. Again, it requires remaking supply chains. There are going to be probably some disruptions. Today, the tariffs, the port of call tariffs kick in, I think. I don't know, I haven't checked. But they were supposed, I think, to kick in today or yesterday, I forget. But anyways, this could be quite disruptive, but there will be an emphasis and there will be a political support for rebuilding shipping. Now that takes time. Other countries may benefit in the meantime, because the United States, while rebuilding its shipping industry, is going to have to build, frankly, ships in places like Korea, like South Korea and Japan, which actually have that more capacity than we currently have in the United States. But I think that definitely is exactly part of this trend. Now about tariffs, I think that there are more tariffs to come. And I mean, if I think about short term within, and shipping is actually a good segue into that. But if we think about, even if the reciprocal tariffs are negotiated away in 90 days and you have deals with Japan and Europe, and that's still a big if, it's not, they could actually return, you still have a number of shoes to drop. So market volatility and fears will last for a while longer. As I mentioned, I have the shipping port of call tariffs today. In the next few months, you're going to have tariffs on semiconductors, car parts, they may get pushed back because the disruption is too big, pharmaceutical, and then lumber and copper, maybe. I don't have it here. This list is not exhaustive. The reciprocal tariffs, I mean, they should be negotiated. Apparently, markets moved today because of potential good talks with Japan, though they continue. The major risk here is a US-EU trade war. That's sort of the one that is probably more important. And then, of course, you could have additional tariffs on buyers of Venezuelan and Russian oil, 25% tariffs on, again, it'll get back mostly China and India as a threat. but that's part of a sanction regime. So again, there are more things that can happen in the next few months. We're not out of the woods yet. At the same time, I would say that at some point, Trump is incentivized and constrained and needs to provide certainty on trade soon. We've been saying this for at least a month and a half. Scott Bessent, the Treasury Secretary, said that this week, that in 90 days, you're going to have more certainty, because uncertainty itself can cause market problems. The question until last week in markets was, is there a Trump put? Well, there is. We saw what happened in bond markets, in equity markets, and that's what got the reciprocal tariffs to be delayed. We can have more delays, we can have more negotiations, more exemptions. And again, I think there are going to be more trade policy moderations, walkbacks. And I think Trump, both politically and economically, from a self-preservation, political self-preservation perspective, needs certainty by mid-year. Now, am I sure of that? No. It's a call, I would say, with medium confidence, but there are good reasons for that. The first one is tariffs are not popular. And that's the chart on the left here. And what this shows is basically that when people were asked what Trump should do in his first 100 days in office, people focus on inflation, immigrations, jobs, unifying the country, which is it's a misnomer for cultural wars. But only 2% cared about tariffs as an end. As a mean, sure, but most Americans are not wedded to tariffs. And of course, as tariffs have negative effects, that will impact Trump's popularity, that will impact markets, which act as a restraining factor. We see the chart on the right, and we see what happened with the Liberation Day spike in long-term U.S. Treasuries, and with the financial stress index jumping, chart on the right. So this acts as a constraint on Trump. There are two other constraints on Trump. First is the fact that while Trump's popularity is at an all-time high, basically, it's barely over water. He's a polarizing president. It is starting to drop, and it's starting to drop because of these economic negative surprises, tariff-related. It can drop quite fast if his favorability rating, the net favorability is minus 20%, so 40% favorability. At that point, he will have trouble with the Republicans, which are already opposing tariffs, more with courts, with businesses, with lobbies. So he's quite constrained. The other thing that constrains Trump is what the chart on the right shows, which is basically that Trump needs Republicans to win the midterm elections in 2026. If they do not, Trump will become a lame duck. He will face a number of impeachments, and depending on how badly Republicans lose, he could actually be removed from office. And I get the chances of that are not high, but the administration is aware of this. So the upper panel in the chart shows the seats won by Republicans in the House with under 15% margin of victory. All these would be gone if there was a recession or a massive market crash. Think something on the par with 2000. So at that point, Democrats are going to have something like 240 seats in the House, easily to push impeachment through. Now in the Senate, if the same dynamic plays out, Republicans stand to lose about 10 seats. That's a problem for Trump, because if he loses 10 seats, the Democrats have a 57 majority in the Senate. You need about 66 plus senators to remove the president from office in case of impeachment. And there are at least 10, 12 Republican senators that are anti-Trump. So again, the risk of him being removed from office if Republicans get crushed in 2026 is not zero. The talk of Trump running again in 2028, I think that's not going to happen. But this possibility, which is not really discussed, I think it's something that will constrain him. And as I said, he has to return to more market-friendly policies, which is why he got elected. So in the meantime, as he doesn't do that, of course, you have chart on the left, you have a potentially trade policy-induced economic downturn. Alpine macro thinks the economy is going to slow down. We may skirt a recession. But again, the indicators, the confidence indicators, the GDP forecasts are not good. Trade balance has dropped on front-running tariffs. And the chart on the right shows the U.S. Economic Surprise Index, which, along with other developed countries, and well, one doesn't look like the others, does it? So, we are, the longer this goes, the longer the uncertainty, the longer the tariffs are kept in place at sort of sky-high levels and not, moderated. We'll have higher tariffs no matter what, but at least at a manageable level, the more the Trump administration risks a market, obviously a market and a severe economic dislocation.